Everyone thinks modern banking is a recent invention. They are wrong. Its roots stretch back centuries, with some practices eerily familiar. Before the digital age, access to quick cash was a far more perilous undertaking. For centuries, individuals facing immediate financial shortfalls often turned to local lenders, pawnbrokers, or even loan sharks. These were informal arrangements, often with steep repayment terms, built on a desperate need for liquidity. The early 20th century, particularly in America, saw a surge in these informal lending practices. The industrial boom and the Great Depression exacerbated this need. Many workers lived paycheck to paycheck, and an unexpected expense, a medical bill, a car repair, could send them spiraling. Without access to traditional bank loans, which often required collateral or good credit, these informal lenders became a last resort. Interest rates, though unregulated, were notoriously high, reflecting the risk and the borrower's urgent situation. The term payday loan itself began to solidify around the mid-20th century. It described a short-term, high-interest loan, typically due on the borrower's next payday. The loan was often simply an advance on a future paycheck, with a significant fee attached. This model offered immediate relief, but frequently trapped borrowers in a cycle of debt, as they struggled to repay the principal and the escalating charges. By the late 20th century, especially from the 1980s onwards, the payday loan industry began its rapid expansion, fueled by deregulation and the rise of storefront lending operations. Companies established themselves in accessible locations, offering what appeared to be straightforward solutions to temporary cash flow problems. Advertising often highlighted speed and ease of access, rather than the true cost of borrowing. The internet brought a new dimension to payday lending. Online lenders emerged, making it possible to apply for and receive funds without ever visiting a physical location. This convenience, however, did not change the fundamental nature of the product: short-term, high-cost credit. The annual percentage rates, or APRA, on these loans could often reach into the hundreds, even thousands of percent. Regulators, both in the UK and US, have since grappled with how to oversee this industry. Concerns over predatory practices and the debt trap cycle led to various attempts at consumer protection, including caps on interest rates and fees. However, the demand for short-term credit persists, as do the companies willing to provide it, often adapting their models to navigate new regulations. Understanding the history of payday loans, from informal lending to modern digital platforms, helps illustrate the persistent human need for immediate funds and the complex evolution of financial systems designed to meet and sometimes exploit that demand. It's a narrative of economic pressure, regulatory response, and the enduring search for quick financial solutions. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for more deep dives into the intricate systems that shape our financial world. This video is for educational and informational purposes only and is not financial advice. Always do your own research.